By 2024, Australia's superannuation system hit 4.1 trillion. That's more than double Australia's entire economy that year, which set around 1.78 trillion in GDP. And just to give you more context, the Future Fund, which is like Australia's national savings account, aka the Sovereign Wealth Fund, had about 307 billion. Meanwhile, the total Australian stock market was worth 3.37 trillion. So superannuation isn't just some side gig, it's massive. It's actually the second biggest asset for most Aussies, right after their home equity. Today, I want to walk you through what I found after spending about 5 hours researching the best super funds in 2025 across different risk profiles: conservative, balanced, growth, and high growth. I know you love this kind of deep dive product reviews like our yearly savings accounts and debit cards and brokerage account reviews. So if you haven't already, hit subscribe. You give me a great excuse to do this research, and honestly, I benefit just as much in the process. Let's jump into it. Alright, before we get into the actual topics, let's quickly talk about how these funds are structured. Super funds usually give you a few different ways to invest your money. There are hands-off options where they build the portfolio for you, and hands-on options where you choose the ingredients yourself, and direct investment options where you can pick individual shares and ETFs, usually with some limits. In this video, we're focusing on the hands-off option. These are the ones where the fund does the mixing for you, blending growth assets and defensive assets based on your risk tolerance. Growth assets include stuff like shares, equity, ETFs, infrastructure, and private equity. These can go up a lot over time, but they also bounce around a bit in the short term. On the other hand, defensive assets are more about stability, things like bonds, cash, or high-quality property trusts. They don't grow as fast, but they are steadier, especially if you're closer to retirement and don't want too much volatility. When you are younger, you got time to ride the ups and downs, so it makes sense to lean more into growth. As you get older, the idea is to shift more into defensive stuff to protect what you've built. Super funds usually offer a few pre-made portfolios based on these balance. Conservative, mostly defensive, around 70% with just 30% in growth. And balanced, normally a 50-50 split. And this is actually the default option, often called My Super, that your employer might stick you into if you don't choose yourself. And growth flips that ratio, about 70% in growth and 30% in defensive. High growth, even more aggressive, 90% in growth and 10% in defensive. Now, if these proportions stay the same over time, the fund is what we call a target risk fund. That means that you need to manually switch to a more conservative option as you get older. But some funds do that automatically for you, and these are called target date or life cycle funds. They start aggressive while you're young and gradually become more conservative as you approach retirement. These are pretty popular in the US, but we're seeing more of them here now. Vanguard Super, Aware Super, AMP, and Australian Retirement Trust ART all have life cycle options. For this video, we're sticking to target risk funds, the ones that you set and leave until you're ready to switch. If you're keen to dive into the more DIY hands-on side of super investing, let me know in the comments. Just type hands-on and I will know what to make next. Let's kick things off with the conservative options, and these are usually more focused on capital preservation, so they lean more heavily on defensive assets like bonds and cash, with just a smaller slice in growth assets. Coming in at number 3, we've got HESTA's conservative option. This one aims to beat inflation by about 1.5% each year. Over the past 10 years, it's delivered an average return of 4.99% per year. The fees are pretty reasonable, 0.47% in total, which includes investment and transaction costs, plus a small performance fee. There's also a separate admin fee of 0.15%, though it's capped once your balance hits a certain point. As for where your money goes, HESTA spreads it across a wide range of assets: Aussie and international shares, private equity, infrastructure, property, cash, even alternatives. It's a well-diversified option for those who want a little growth but mostly want to keep things steady. And number 2 is MLC's low-cost conservative balanced. It's an actively managed fund that targets a slightly higher return, about inflation plus 2%. It's delivered around 5% annually over the past decade. The standout here is the low investment fee, just 0.29%. It invests across fixed interests, both Australian and international, shares, infrastructure, and property. For a conservative fund, that's a solid spread, and the low cost make it a strong contender. Now at the top of the list, First Super conservative balance. This one has delivered the highest 10-year average return of the group, about 5.69% per year. The asset mix is 66% defensive and 34% growth. It's what's called a fund of funds, meaning it invests in a bunch of other funds that hold things like fixed income, unlisted infrastructure and property, and both local and international shares. The cost is on the higher side, 0.45% per year in total fees, but that's not too surprising given the broader investing strategy. Alright, now let's talk about the balance category. This is where most Aussies super funds are parked, whether they've chosen it or not. If you never pick a specific super option, chances are you are in a balanced fund, especially one under the government's My Super label. As of mid-2022, around 14.1 million super accounts were sitting in My Super options. That's roughly 60% of all accounts and nearly 887 billion in assets. So yeah, it's a big slice of the pie. Let's go through the top 3 performers in this space. Number 3, Cbus growth. What's interesting about Cbus is that their default My Super fund isn't your usual 50-50 balance setup. Instead, they've gone with a growth heavy mix, about 75% in growth assets and 25% in defensive. So technically, it leans more aggressive than most balanced funds. Over the last 10 years, it's returned 7.73% annually after fees, which total around 0.74% per year, including investment costs, performance fees. You're looking at a net return before admin fee of 7.47%. Not bad for a fund that takes a bit more risk to push up returns. Number 2, Hostplus balance. This one has been a consistent performer with a 10-year average growth return of 8.75%. Fees are a bit steeper here, around 1.02%. When you add everything up, but even after cost, the fund still delivers 7.73% annually. That's a 5.33% return above inflation, which is really solid. Like Cbus, Hostplus also tilts towards growth with 76% in growth and 24% in defensive. It's also got strong customer feedback, earning a 94% satisfaction rate in Finders Awards, taking out the number 2 spot overall. At the top of the list is the Art Balance option, which has quietly built a strong track record. Over the past decade, it's delivered a net return after investment fee and transaction cost of 8.31% per year. The fund doesn't shout the loudest, but performance-wise, it's a standout. It combines long-term returns with competitive fees, which is exactly what you want in a balanced option. Now, just in case you're wondering if super funds in Australia are actually doing a good job overall, there's a study from the Monash Center for Financial Studies that might reassure you. The research looked at super funds' performance over the past 20 years and found that across the board, Aussie super funds outperform market benchmarks, not just in good years, but during downturns too. The key metric here was risk-adjusted return, measured through something called the Sharpe ratio, basically how much return you're getting for the risk you're taking. Red Super, Hostplus, and Care Super came out on top in that ranking. Also worth noting, many top super funds increased their exposure to big US tech stocks, the so-called Magnificent Seven, in late 2024. So if you're wondering why your super is doing well, it could be thanks to Apple, Microsoft, and YouTube that you're watching. Now, let's move into the growth category. This is where things get a little more exciting, especially if you're someone with a longer investment horizon, think 7 years or more. These options lean heavily into higher growth assets, so you'll see more ups and downs, but also more potential over the long run. Starting off at number 3, we've got First Super's growth option. Over the past decades, it's averaged 8.48% per year after investment fee and transaction costs, which is solid. The fee sits at 0.82%, and the portfolio is made up of 80% in growth assets and 20% in defensive. So it's definitely tilted towards the higher risk side, exactly what you'd expect in this category. Next up is Hostplus growth, which edges ahead slightly with an annualized net return of 8.52% after investment fee and transaction cost. It charges a bit more in fees compared to First Super, 0.91%, but it still performs strongly. Hostplus continues to be a popular choice for its track record and consistent management across various risk categories. At the top of the growth list is Prime Super's managed growth. It delivered the highest net return in this category while keeping fees relatively low, around 0.52% for investment and transaction cost. Now, onto the high growth options. These are made for investors who have decades before retirement and are willing to ride the market roller coaster for better returns down the line. In third place, we got UniSuper High Growth, which delivered a 10-year average return of 8.88% with fees around 0.71%. The fund targets returns about 4% above inflation over a 7-year period, which is a pretty ambitious benchmark. As of the end of 2024, it had over 10.7 billion under management, a sign of trust and scale. Second on the list is First Super Shares Plus, with a net return after investment fees and transaction costs of 9.54% over 10 years. The fees are slightly higher than UniSuper, around 0.85%, but the returns have kept up. It's definitely an aggressive option, so it suits investors who are comfortable with more risk. And topping the list here is the ARD High Growth option from Australian Retirement Trust. It boasts a 10-year net return of 9.58%, making it the strongest performer in the high growth category. The fee is 0.72% for investment and transaction costs, plus an admin fee of 0.1% on your first 500k. Strong returns, decent fees, and a solid provider. Is easy to see why this one is at the top. So there you have it, the top 3 performers in each risk category. And as we've seen, even though some funds fall under the same label, like high growth or balance, they can be structured quite differently. Asset allocation really matters, and that difference is what leads to changes in performance and volatility. And hey, if your fund didn't make the list, don't stress. It doesn't necessarily mean it's not performing well. A lot of people choose DIY, the single asset strategies, and in this video, we'll focus just on pre-mix, risk-based options. If you're interested in seeing a breakdown of lifecycle funds or want a deeper look at the hands-on DIY options, drop a comment with lifecycle or hands-on. I'd love to do a comparison in an upcoming video.